Hyde, joined by Simon Rubinsohn, RIC's chief economist, and notably, of course, you see house prices falling by some 3%. Could that figure have been even worse if there wasn't a shortage of supply? How much has that helped reduce the negative impact?
Well, I certainly think it's fair to say that the figure could have been worse, because 3% is neither here nor there in the scheme of things, actually. And one of the interesting features, I suppose, of the latter half of this year has been that a huge amount of negative news flow has been thrown at the housing market. Yet actually, if you look at the price indices, most of them suggest that prices have either edged up or flatlining in the second half of the year. So there's something going on at the moment which we think will continue through 2012, and I think shortage of stock both in the second-hand market and the new build sector are going to be our key elements of that support process.
And let's divide it up region by region, because there is some regional deviation in there. Simon, where were you going to expect the biggest falls to come? Seemingly London actually seems to be quite insulated from all of this.
Well, it has been this year. Obviously, the story this year has been foreign buyers and, city money again being recycled into the London property market. And while that may not be quite as strong a story in 2012, it's still going to be there. There are pockets of weakness in London, let's get that clear. It's not a uniform picture. As we go further north, and I know it's a bit of a stylised description, you are going to see weaker trends emerge. But even within that, there are going to be pockets of strength. And I wouldn't sort of say that some of the big cities, say for example Manchester, for example, is going to do particularly badly.
Given the high levels of unemployment that we are seeing in the UK, do you see any repossessions, particularly building next year?
Again, the interesting thing about repossessions is they should have been higher this year. The CML came in with a much higher forecast, been forced to revise it down. And we don't think things are going to get an awful lot worse next year, despite the rise in unemployment that is widely projected. Interest rates, mortgage costs, if you've got a mortgage, your cost is pretty low, a servicing cost. And we've seen the way that banks are operating, not just in the residential sphere, but also in the commercial sphere. This is, the extend and pretend, a similar sort of philosophy in the residential sector as well, to the extent that really they see it, one, from a PR point of view, there's no great mileage in pushing for more repossessions, and also it's sort of cannibalising the market. It's going to end up with more distressed sales, pushing prices down. The asset books of many of these banks will inevitably suffer as a result.
So cutting them some slack. So if we're not buying particularly, are we renting more? Is the rental market picking up next year, do you see?
Well, the rental market's been pretty firm for the last 2 years. We're still seeing very strong signals coming back on our letting survey. Tenant demand is still strong. Supply's picked up a bit. The balance between the two is not as strong as it was, but it still favours demand. And as a result, rents are still likely to climb. Now, some of the momentum and that growth of rents is slipping, is easing. And it's not surprising. We're picking up from our surveys some resistance from tenants, but actually they don't have that much choice, because if they can't get the mortgage in the first place to get on the housing ladder, they have to rent. So it's a difficult balance. There's no longer quite the same cost advantage from renting, but they don't have much choice.
So pretty few and far between, stuck between a rock and a hard place.
Absolutely.
Simon Rubinsohn from the RIC's chief economist, thank you very much indeed for joining us.